There's always a reason not to be in the market, right?
Yes. And what are the reasons today, perhaps?
Or the many reasons today. Yeah. I would say there's more than a few. Which one has your attention as we look at Dow 27,000? Not too far out there.
In the short term, I think the thing that's most worrying is that you've had this, obviously excellent rally in the first quarter after a very bad fourth quarter, but it's happening in a context where you see continued profit warnings from banks, negative guidance. We had Walgreens, you had Prada last week. It's kind of a drip feed that really started, or most notably, with Apple last December, and that hasn't changed. So that seems to be the near-term concern for us. We can't really see equities rallying significantly from here without a turnaround in the outlook from corporations. About their profitability.
Arend, Alan Greenspan and others would say the equity markets are a confidence builder for an economy, and a better economy is a confidence builder for the market. Explain the confidence metric right now, or dynamic, I should say, between the greater economy and the stock market.
Yeah, so we have survey implied growth, for instance, where you can take all the surveys globally and sort of back out what it's implying in terms of growth. That's been cut in half the last 12 months. It's gone from over 5% to about 2.5%.
And why are stocks going up? I want to talk to an economist about this.
Right. So I think partly what's happened is we've gone from being uber pessimistic late last year to now pricing some stabilization. So we think equity markets are pricing about 3% growth, but they're not priced for acceleration. So we think we're on the cusp of a major synchronized acceleration in global growth here. It's going to come in the next 3 to 4 months. Markets are not yet pricing that. And to your earlier point, I think what people are waiting for is some of the negativity, the bad news still to be out of the way. Brexit, car tariffs, etc.
But see, Aaron, like what, 2-3 weeks ago, we were talking about the end of the world, recession, yield inversion, and suddenly we're like picking up. Where does that pickup actually come from?
Yeah.
Is it the threat of deflation being taken off the table, or something else?
So we were not talking about that. So I think it was a complete overreaction by both the market and the central banks to things that were largely behind us. I think the key point on the tariffs that we were talking about is that these are level effects that are already dissipating. So when you look at some of the disruption in the U.S. in consumer durables and employment, all those effects are coming out of the data now. So by the time you get to March, that's behind us, even if you do not reverse the tariffs that are in place.
Right, but then you have the IMF and Christine Lagarde saying that actually the global economy has lost momentum since January.
Yeah, it's a backward-looking assessment. I spent a long time working at the IMF, where we're in the business of looking at annuals, not monthlies or quarterlies. So that is going to tell you what's already happened, not what's about to happen.
Okay, do you agree with that?
Yeah, by and large, yes. We think we're seeing a stabilization in China, which is then going to lead to a stabilization in Europe. Whether we get a real upswing, fingers crossed. That would be, I think, probably most important for the European equity outlook. But overall, at a minimum, we do see stabilization.
To your terse comments on how the IMF looks at economics, is it any different at central banks? Can they actually get out front, or are they IMF-y?
No,
that's a new word.
So central banks, I mean, I'm also an ex-central banker. It's the exact same. They have no more information than we do, okay? So they're looking at the same data, but in the markets, we are hyper-focused on the near term and the high-frequency turn in the data.
You're telling me in the World Economic Outlook, with 472 PhDs, all smarter than me, that those people are not in any way extrapolating out in time?
There's no top-down model. It's all bottom-up, done by all the individual teams, and the most junior person on the team actually does the growth forecast. So,
would you like to join us in Washington next month at our IMF
Aaron, this is, and we did actually write a wonderful story thanks to Simon Kennedy, who was spearheading that effort and seeing why economists were so wrong at predicting recessions. Yeah. So are you saying that markets get it better, and why? What are they looking at?
Right. No, so not necessarily. So if you look at the S&P, for instance, how well has the S&P done at predicting not just recessions, but turning points in the cycle? It's also not got a great track record. So and particularly the last 20 years, that track record has gotten worse. So I think the key thing when you're comparing these forecasts is you have to look at the vintage of the forecast. So the IMF only does their forecast twice a year. The market is repricing things daily. So you have to line those up in terms of when you're making the comparison.
So how do we extrapolate? I mean, if we're getting a clinic over here on the look back from a bottom-up view, how do our viewers and listeners extrapolate out with confidence?
Well, probably shouldn't be too confident, especially when one's predicting the future. I think the lesson, perhaps, is when we see these downward revisions from the OECD or the IMF or the World Bank or whomever, we probably paid too much attention to them, if you will, in terms of what we should expect from the market. So I think that's absolutely a valid point. If we look at the kind of the short-term high-frequency data that we're getting, let's take the PMIs as a clear example, that's going to be a much better indicator of what's likely to happen over the next 3 months than a forecast from the IMF.